For the better part of the last economic cycle, Florida was more than just a state. It was a financial safe haven. It served as the ultimate capital flight destination for wealth fleeing the high taxes of the Northeast and the regulatory density of the West Coast. The narrative was unshakable. Move capital to Florida, enjoy zero state income tax, and watch property values appreciate in a perpetual upward trajectory. Investors and retirees alike poured billions into the peninsula, driven by a fear of missing out on what seemed like the last affordable coastal real estate in America. But in the current market, that narrative has hit a violent, mathematical pressure point. The sunshine premium has officially inverted into a liquidity trap. What we are witnessing right now is not a standard seasonal cooling. It is a structural repricing of the entire Florida housing market. The inventory that was virtually non-existent 12 months ago is now flooding the market at a pace that is overwhelming buyer demand. Sellers who could once command bidding wars are now staring at stale listings and aggressive price cuts. The leverage has shifted. The panic to buy has been replaced by a panic to sell, driven by holding costs that have become mathematically unsustainable for the average property owner. This pressure point is being driven by a convergence of three specific catalysts: an insurance insolvency crisis, a condo association regulatory shock, and a reversal in domestic migration patterns. If you own property in Florida, or if you are considering allocating capital to the state, you need to understand that the rules of engagement have changed. The equity you believe is locked in your property may already be eroded by the new cost of ownership. But there is a specific legislative trigger that is forcing thousands of condo owners to sell their units for pennies on the dollar right now. We will break down this special assessment shock in the second half of this report. But first, we must analyze the inventory flood that is drowning the single-family market. The inventory supercycle. To understand the severity of this pressure point, we must look at the supply side of the equation. During the peak of the recent boom, active listings in Florida plummeted to historic lows. Scarcity drove prices up. Today, however, we are seeing a supply supercycle. In major metros like Sarasota, Cape Coral, and North Port, active inventory has exploded, rising by triple digits year over year. This surge is not being driven by new construction alone. It is being driven by exit listings. These are homeowners and investors who are rushing to the exit because the cost to maintain the asset has exceeded their ability to pay. When you combine rising mortgage rates with insurance premiums that have tripled, the monthly carrying cost of a Florida home has detached from local wages. Sellers are dumping properties, not because they want to move, but because they have to stop the bleeding. Historically, when inventory rises this sharply while demand softens, price capitulation follows. We are currently in the standoff phase, where sellers are refusing to lower prices to 2019 levels, and buyers are refusing to pay 2022 prices. But with inventory piling up, the laws of economics dictate that sellers will blink first. The absorption rate, the speed at which homes sell, has slowed to a crawl, creating a backlog of supply that will weigh on prices for the foreseeable future. Now that you understand how inventory saturation creates a ceiling on price appreciation, you must see how the demand side of the equation is collapsing simultaneously. The next factor is the migration reversal, a trend that proves even a tax-free state has a breaking point for new residents. The migration reversal. For years, the bullish case for Florida real estate was built on a single statistic: 1,000 people are moving here every day. That demographic wave was the engine of the economy. It fueled construction, services, and real estate appreciation. But in the current cycle, that engine is sputtering. We are seeing early data suggesting a net migration slowdown. While people are still moving to Florida, a significant number are now moving out. The half-back phenomenon is accelerating. Retirees who moved from New York to Florida realized the cost of living, insurance, HOAs, services, was higher than anticipated, and are now moving halfway back to states like North Carolina, Tennessee, or Georgia. Why is this happening? Because the arbitrage is gone. The cost advantage of living in Florida has evaporated due to the explosion in non-mortgage housing costs. When you factor in the highest home insurance rates in the nation, rising property taxes, and general inflation, the math of retiring in Florida no longer works for the fixed income demographic. The wealth migration is pausing to reassess the risk. However, while the single-family market struggles with migration shifts, The condo market is facing an existential threat that is far more immediate. There is a ticking time bomb in the Florida statutes regarding structural integrity that is about to bankrupt thousands of unaware owners. This is the single biggest risk to capital in the state right now. If the single-family inventory glut was a warning sign, the next segment of the Florida market represents a full-blown crisis. We are shifting our focus to the vertical real estate market, condominiums, where a legislative mandate has triggered a special assessment shock that is wiping out equity overnight. This is the direct fallout from the tragic Surfside collapse, and while the intent was safety, the financial consequence is a mass liquidation event. The condo cliff. Following the Surfside tragedy, Florida passed new laws requiring strict milestone inspections and fully funded reserves for any condo building over 3 stories tall. For decades, condo associations had been deferring maintenance and waiving reserve contributions to keep monthly HOA fees artificially low. That era is over. By the end of this year, thousands of associations must prove they have the cash on hand to fund major structural repairs. The result is a mathematical impossibility for many owners. Associations are issuing special assessments ranging from $20,000 to over $100,000 per unit to meet the new requirements. For retirees on fixed incomes or investors relying on cash flow, this is a solvency crisis. They simply do not have the liquidity to pay a 6-figure bill within 30 days. Consequently, we are witnessing a flood of distressed condo listings. Owners are rushing to sell before the assessments are finalized, or because they have already been hit and cannot pay. But buyers are savvy. They are reviewing the association documents, seeing the looming assessments, and walking away. Or, they are demanding price reductions equal to the assessment amount. This is driving condo values down by double digits in key coastal markets. This condo cliff is creating a 2-tiered market: newer buildings that are compliant and expensive, and older buildings that are technically insolvent. If you own a unit in a building constructed before 1995, your equity is at extreme risk. The market is pricing in the liability of deferred maintenance, and the discount is steep. But if you think the special assessment crisis is bad, wait until you see the insurance disaster that is amplifying it. While condo owners struggle with structural costs, the entire state is grappling with an insolvency event in the property insurance market that threatens to make mortgages unobtainable. The insurance insolvency crisis. Florida's property insurance market is currently the most dysfunctional in the developed world. It is driven by a toxic combination of litigation abuse, fraud, and catastrophic weather risk. In the current cycle, premiums have not just risen, they have exploded. The average homeowner in Florida now pays nearly 4 times the national average for insurance. This is not just an expense, it is a deal killer. When insurance premiums rise from $2,000 to $8,000 a year, it destroys the affordability of the home. It increases the monthly payment by $500, which disqualifies thousands of potential buyers who no longer meet the debt-to-income ratios required for a mortgage. For investors, it obliterates net operating income, NOI. A rental property that cash flowed at $300 a month suddenly loses money every month when the insurance bill arrives. Worse, many private insurers are leaving the state entirely or becoming insolvent. This forces homeowners onto the state-backed insurer of last resort, Citizens Property Insurance, which is now dangerously overexposed. If a major hurricane hits a populated area, the entire system faces a liquidity crisis. Banks are reacting to this risk by tightening lending standards. In some coastal zones, lenders are requiring higher down payments or refusing to lend at all if the property is uninsurable in the private market. This creates a cash-only market, which inherently limits the buyer pool and depresses prices. When you remove leverage from a real estate market, values fall. Now that you understand how uninsurable assets destroy liquidity, you must see how this crisis bleeds into the broader economy. The next pressure point is not about the buildings themselves, but about the people who live in them. We are seeing a service economy exodus that threatens the very lifestyle Florida sells. If the insurance crisis is the hammer crushing property values, the next pressure point is the anvil. We are talking about the structural integrity of the Florida economy itself. For decades, the state's business model relied on a steady influx of retirees supported by a low-wage service sector. But as the cost of living, specifically housing, skyrockets, That model is breaking. The people who serve the food, clean the pools, and staff the hospitals can no longer afford to live where they work. The service worker exodus. Florida is currently experiencing a livability crisis for its working class. Rents in major metros like Miami, Tampa, and Orlando have surged far faster than wages. When you combine this with the highest inflation rate in the nation, driven by housing and insurance costs, you get a workforce that is being priced out of the state. We are seeing a net migration of service workers out of Florida and into cheaper states like Alabama and Mississippi. This creates a labor shortage that drives up the cost of services. Have you noticed that restaurant prices in South Florida now rival Manhattan? Or that getting a contractor to fix a roof costs a fortune? This is cost-push inflation. For real estate investors, this matters because it degrades the quality of life for your tenants and buyers. A city without a functioning service sector becomes less desirable. Long wait times, reduced business hours, and higher costs for basic goods make the Florida lifestyle less appealing. When the lifestyle degrades, the premium people are willing to pay to live there evaporates. The economic ecosystem is fragile, and the housing crisis is severing the roots. But while the workforce struggles, a different group is heading for the exits even faster. The tourist investor who bought into the Airbnb hype is about to face a reckoning. The short-term rental market in Florida is oversaturated, and the revenue collapse is triggering a wave of panic selling. The short-term rental implosion. During the pandemic boom, thousands of investors bought properties in Florida with one goal: short-term rental arbitrage. They leveraged cheap debt to buy homes in non-traditional tourist areas, banking on high occupancy rates and daily pricing. It was the gold rush of the 2020s. But in the current cycle, the gold is gone. We are witnessing a massive oversupply of short-term rentals, STRs. In some Florida markets, the number of Airbnb listings has doubled in 2 years. At the same time, revenge travel has cooled, and international tourism hasn't fully recovered. This supply-demand imbalance has caused occupancy rates to plummet. RevPAR, revenue per available room, is down significantly year over year. Investors who bought at the peak based on 2021 revenue projections are now bleeding cash. Their mortgage and insurance costs are fixed or rising, but their income is falling. They are realizing that owning an Airbnb in a saturated market is not passive income. It is a second job that loses money. This is triggering investor capitulation. These owners are now listing their furnished properties for sale, adding even more inventory to an already flooded market. Buyers can spot these listings a mile away. They are the ones with the turnkey descriptions and the desperate price cuts. This shadow inventory is a dead weight on home prices across the state. Now that you understand how the collapse of the short-term rental market adds supply pressure, you must see the final, most dangerous piece of the puzzle. The wealth effect that drove Florida's luxury market is reversing. The high-net-worth buyers are not just pausing, they are looking elsewhere. The final pillar of the Florida housing thesis was the unstoppable luxury market. The belief was that even if the middle class was squeezed, the ultra-wealthy would always buy waterfront property. Cash buyers, we were told, are immune to interest rates. But in the current cycle, even the high-end market is flashing warning signs. The smart money is not immune to valuation concerns. In fact, they are the most sensitive to it. The luxury liquidity freeze. We are seeing a significant slowdown in high-end transaction volume in key markets like Palm Beach, Naples, and Miami Beach. The days of sight unseen, multi-million-dollar offers are gone. Instead, luxury listings are accumulating days on market. Why? Because the wealth effect is reversing. High-net-worth individuals are looking at the yield on risk-free assets like treasuries and comparing it to the carrying costs of Florida real estate. When you can earn 5% on your cash without risk, parking $5 million in a Miami condo that costs $100,000 a year to insure and maintain becomes less attractive. The opportunity cost of buying luxury real estate has skyrocketed. Furthermore, wealthy buyers are acutely aware of the insurance and climate risks. They are self-insuring, which means they are underwriting the full risk of asset loss. As storm models become more severe, the risk premium they demand increases. This leads to lower offer prices. We are currently in a price discovery phase where sellers are holding on to 2022 valuations, and buyers are bidding based on 2024 risks. The result is a stalemate. The final verdict. So, what does this convergence of inventory flood, insurance crisis, and condo insolvency mean for you? Florida is currently undergoing a violent repricing. The easy money era is over. The state is transitioning from a growth market to a risk management market. For homeowners, if you own a home in Florida, particularly an older condo or a property in a high-risk flood zone, you need to audit your position immediately. Do not rely on Zillow estimates. Look at the active competition in your neighborhood. If you need to sell in the next 12 to 24 months, you must price ahead of the market. Chasing the market down in a high-inventory environment is a recipe for selling at the bottom. For buyers, we are entering a period of maximum opportunity for the disciplined. Cash is king once again. As distressed inventory from insolvent condo associations and capitulating investors hits the market, there will be deals. But you must be surgical. Avoid buildings with underfunded reserves. Avoid areas where insurance is becoming unobtainable. Look for motivated sellers, those who must sell due to life events or financial stress, and make aggressive offers. Patience will pay dividends. For investors, the days of buy and hold for appreciation in Florida are paused. You must underwrite for cash flow in a high-cost environment. Assume insurance will go up. Assume taxes will go up. If the numbers still work with those conservative buffers, buy. If they rely on rent growth that isn't happening, walk away. The Florida market is not crashing to zero, but it is correcting to reality. The pressure point has been hit. The steam is escaping. Whether you get burned or use the energy to power your portfolio depends entirely on how you react to the data we've discussed today. If you found this analysis valuable and want to track the specific zip codes where inventory is rising fastest, make sure you are subscribed.